Over the years, I have worked with tons of families who have made the decision to do a Roth conversion. But there have been a handful of families that I've sat with that had done a Roth conversion in the past and shared with me, Brennan, I really feel like that decision backfired. Now, this is typically because too much was converted at the wrong time, and now all of a sudden they're in a higher tax bracket with a bigger tax bill surprise, and in some cases they're paying significantly more in Medicare cost. Now, this does not mean that the Roth conversion is the villain. It does not mean the Roth conversion is to blame, but it typically means that the execution was not there. Now, I want to be clear, Roth conversions are not for everyone, but in the right case, they can dramatically reduce your lifetime tax bill. They can provide you and your family with significantly more flexibility, and they can protect against all of this money printing and the risk of higher tax brackets in the future. So in this video, I'm going to go over exactly what you need to think about before you decide to do a Roth conversion, so we're saving your family money and not getting caught with any surprises on the back end. I'm Brennan Decima, owner of Decima Wealth Consulting and certified financial planner, and I have helped thousands of families navigate their retirement with confidence. In this video, I'm going to go over three things. Number one, how tax brackets actually work. There's a lot of misconceptions out there that can paralyze people and lead to bad decision making. Number two, how you can find your conversion room. This is the wiggle room left in your tax bracket that allows you to get money into a tax-free bucket without paying more in taxes than you really should be. And number three, the conversations you should be having with your own financial advisor so you can help run the numbers and make a decision tailored to your specific situation. Now, this is not designed to be tax advice. This is designed to be educational in nature. But the more educated you are, the more confident you will be in your decision. Before we dive into Roth conversions, it is really helpful to understand how the U.S. federal income tax brackets work. And there's a myth out there that I think can be particularly paralyzing and very harmful when it comes to planning. The myth is that if you earn more and cross over an income tax threshold, that every dollar is now taxed at the higher rate. I have families that think if they earn $1 more, they're now paying thousands of dollars more in taxes. And that is absolutely not the case. The last thing we want is if you work for a corporation and your boss comes in and says, hey, you've done a great job, we're going to give you a bonus. Your reaction should not be, hey, keep the bonus, I don't want to go into a higher tax bracket. You should be very happy about that bonus. And yes, you may have some dollars at a higher tax rate, but it's not going to impact all of the previous dollars you've earned before. And the reason for that is the U.S. tax code is marginal. So think of it like having buckets. You have a 10% bucket, and when you're pouring water into it, everything in that 10% bucket is going to be taxed at 10%. Once it is full, we now start pouring into the next bucket, the 12% bucket. Those drops of water are going to be taxed at 12%. When that's full, we now start pouring into the 22% bucket, and those dollars are taxed at 22%. So if you're a married couple filing jointly making $180,000, you're in the 22% bracket. But I want to be really clear, that does not mean that every dollar is taxed at 22%. You're going to have dollars taxed at a much lower rate up until certain lines. So why does this matter for Roth conversions? Well, the reason it is so important is it is really, really imperative to know exactly where you are in your bracket and what conversion room you have that allows you to get money into a tax-free bucket without paying more in taxes than you're truly comfortable with. Let's define what a Roth conversion is for anyone that is newer to the concept. A Roth conversion is taking pre-tax dollars from a traditional IRA or an employer plan like a 401k and moving them into a tax-free bucket, the Roth IRA. Now, there is no income limitation on who can convert. There's no cap on the amount you can convert. But when you move money from a pre-tax account to a tax-free account, it is taxable in the year you do the conversion. So, why would someone want to expedite taxes if they're not required to? Why not delay and defer taxes as long as possible? There's a number of reasons for that. For a lot of families that I work with that are in their 50s or 60s, they've done a fantastic job saving. And they have a large amount that is in their employer plan. A good percentage of their nest egg is in pre-tax dollars. Well, if they leave that alone, at age 73, whether they need the money or not, the government is going to require that they start taking distributions. Well, in many cases, those distributions are more than what they need and potentially pushing them into a higher tax bracket later in life. So they're ending up paying more taxes to the government. Number two, we have seen our government print trillions of dollars of debt. Well, how are we going to pay for that debt? We can reduce spending. Maybe we do that. We can increase production. Maybe we do that. Or we increase taxes. So if you're someone that feels like there's a high probability taxes go up in the future, a Roth conversion protects against that. And finally, many families we work with, when they retire, they are married filing jointly. You get 2 standard deductions, you have wider tax brackets. Well, if one spouse passes, that surviving spouse loses a standard deduction. They now have much tighter tax brackets. So the surviving spouse may end up giving significantly more to the IRS once the first spouse passes. So a Roth conversion offers control. It allows you to be intentional about how much and when you pay taxes to create more flexibility for you and your loved ones later in life. Let's walk through the practical application of this. The goal for most people when they do a Roth conversion is to convert as much as they possibly can without moving themselves into a new tax bracket. So there's 3 things that we really need to know to make sure that happens. First, we need to know what our total income is before we do the Roth conversion. Second, we need to know what the top of our tax bracket number is. And finally, we subtract the 2 to get our conversion room. So if we look at a real example, let's take a married couple. They file jointly. Their Social Security, pension, dividends, all of their income adds up to about $150,000. So that's their income before doing the Roth conversion. That's number 1. Well, at $150,000, that puts them in the 22% bracket. So now we look at what the top of the 22% bracket is, and that's $206,000. We subtract the 2 for our conversion room, and that leaves $56,000 they can convert while still staying in the 22% bracket. If they convert more than $56,000, well, now each dollar above $56,000 is converted at 24%. So if someone decides to convert $75,000, the first $56,000 of conversion, 22%. The next $19,000 that they convert, that's going to be at 24%. Is that catastrophic? No, but it is slightly more expensive to convert a little bit more. So just something we need to weigh so there's no surprises. Now, there's 2 main pain points in the tax brackets to be sensitive to. In this example, we're going from 22 to 24. And for most people, do we want to pay an extra 2%? No. But there's 2 main trigger points that are much more painful than a 2% jump. The first is if you go from 12% to 22%, or from 24% to 32%. So when we are converting, we really want to make sure we're not doing a massive jump from 12 to 22 or 24 to 32 in most cases. Now, where people tend to get themselves in trouble is if they do their conversion in January, they can't revoke it later in the year if their situation changes. So if they sell something later in the year or they have a change in their situation that requires a big withdrawal from pre-tax dollars, well, now all of a sudden they may be in a much higher bracket because they've already done the conversion. So typically what we want to look at, unless there is a major market dip, is we typically do Roth conversions at year end because we have a much better understanding of what all the taxation is. We know what mutual fund capital gains distributions are. We know what sales and withdrawals have occurred throughout the year. So at the end of the year, you have a much more precise accounting of where you are, and you can do that conversion without any major surprises. Why would we do it earlier in the year? And that is the slinky effect. Let's take an example where the market had a major dip. So let's say the market goes down 20, 25, 30% in March or April of a calendar year. It's not December, it's early in the year. Well, many of our clients use that volatility as an opportunity to convert. And the reason being is it goes down with pre-tax dollars. We convert those shares at a lower tax cost. And now the recovery is tax-free instead of tax-deferred. And oftentimes, the recovery is covering the cost of the tax bill. So really, really powerful opportunity to use a painful time in the market as a tax reduction strategy for the future. Now, the last thing to consider here is when you convert, it's not always just about tax brackets. When you do a conversion, the dollars you convert are also part of your Medicare AGI. So if you convert a lot of money, it's possible that you're moving yourself into a higher Medicare cost due to IRMAA thresholds. So when this happens, this is typically a scenario where we want to model in not just the income tax cost, but the total cost when we factor in higher Medicare premiums. To be clear, the framework that I shared in this video, it is a really simplified approach, and it is just the starting point. It's designed to help give you a better mental model to determine if and when this might make sense for you and your family. But Roth conversions do not work in a vacuum. They are one lever to pull to potentially reduce your family's tax burden over time. But when I think about putting together a retirement cash flow plan, an investment strategy, when to claim Social Security, or how much healthcare is going to cost, all of those impact how and when Roth conversions fit in. So if you're working with an advisor and a CPA, here's some questions you really want to make sure you ask them. Number one, what is my taxable income, and what changes do you anticipate making this year that would adjust that? What is my wiggle room to convert without going into a higher tax bracket? Does it make sense to convert more into a higher tax bracket? And if I do that, what is the impact on my Medicare cost? What is the impact on my family's legacy? When will I break even? And what is the advantage of doing it versus not doing it? If you can get clear numbers, that's how you know your advisor and your CPA are looking out for your best interest. Tax planning is not about what gives you the lowest tax bill in any given year. It's about what gives you the lowest lifetime tax bill. Most of my clients, they are not doing this as a one and done. Yes, a single year conversion is helpful, but taking multiple years to get as much as we can out of pre-tax into tax-free can make a massive difference in our lifetime tax bill. If you found this video on Roth conversions helpful, go check out my Medicare IRMAA video. Medicare IRMAA is something that is absolutely impacted by Roth conversions, and the surtax is something that you typically find out about 2 years after you've converted too much. And I want to leave you with one final thought before we go. The window between retirement and required minimum distributions at age 73 is one of the most valuable planning windows you will have in your life. Each year that goes by is 1 year that is unused that you cannot get back, so we want to take advantage of it. If this was helpful, consider subscribing. Each week I put out a new video on retirement cash flow, tax reduction, and estate planning strategies. I'm Brennan Decima. I hope you have a great day.